Hello, and welcome to this revision aid for ACCA P5 Advanced Performance Management. My name is Anthony Andrews from London, and I work as a senior accountant for a multinational construction company. I'm also an alumni of the Leaders of Tomorrow program for a global accountancy body. This recording is performance management and control. So, what do we have to learn when it comes to performance management and control as part of the ACCA P5 paper, Advanced Performance Management? Well, performance management and control obviously is a key part of advanced performance management. And one of the things that we need to do is to evaluate the strengths and weaknesses of alternative budgeting models and compare such techniques as fixed, flexible, rolling, activity-based, zero-based and incremental. So basically we're looking at different approaches to budgeting. Another thing we need to do when we're looking at performance management and control is to assess how budgeting may differ in not-for-profit organisations from profit-seeking organisations. We'll be looking at not-for-profit organisations a little bit later on. But one of the things that we're doing at this stage is we're looking at budgeting and how it may differ. We also need to evaluate the issues raised by advocates of beyond budgeting. So when we look at performance management and control, in this context, we're specifically looking at alternative approaches to budgeting for different types of organisations, and also the movement with regards to beyond budgeting. So, looking at these alternative approaches to budgeting, we need to think of the performance cycle. Now, what is the performance cycle? Well, if we think of the acronym PRIME, P-R-I-M-E, we start our performance cycle with planning. Got to plan something. Once we are in the throes of making our plans, we need to decide who's responsible for executing those plans. As we decide who's responsible for executing those plans, we also need to think about how those plans are actually going to be integrated within the business. P-R-I of PRIME is planning, responsibility, and integration. As we integrate, we need to make sure that the people involved in that integration are motivated. And then finally, once people are integrating the elements of this performance, we need to then evaluate what's actually happening, hence the control part of budgeting and control. So for example, if we put together a budget, we need to plan, we need to decide who's responsible, we need to integrate it, we need to ensure motivation, and then we need to evaluate it. That's our PRIME. Now, when we're looking at PRIME, we need to look at it as a performance cycle, but also we need to be able to compare it and compare that performance cycle to other ways, means and methods. Let's look at budget systems. So with each budget system, whether it will be an incremental budget, a zero-based budget, a rolling budget, a flexible budget, or an activity-based budget, we still need to plan those budgets, we still need to decide who's responsible, we need to integrate those budgets, we need to make sure that the people involved are motivated, and we need to evaluate. And one of the key things that we need to do in ACCA P5 is we need to be able to evaluate each of these 5 different types of budgeting methods. So an incremental budget. An incremental budget is, of course, just taking the budget from last year or from a previous period, usually 12 months, and we make some changes. We make some changes maybe to inflation, to sales growth. We kind of, just make an incremental change and basically go again with what we did last year. Usually the increments are based on actual results. So we may have had a budget for last year, then we add our results for last year. We look at those results of last year. We make a few changes to them, maybe increase a little bit here and there, just to kind of push performance. Maybe make account of inflation, etc. Maybe if there's any tax or VAT changes, any wage increases, things like that. We make a few changes, and we basically go again with a very, very similar budget to what we had last year. It's actually quite easy to do that. Doesn't really take that long. Make a few tweaks, and there you go. Budget made. So one of the good things about incremental budget is that it's easy, it's quick, and if it's easy and quick and it doesn't take much time, doesn't take much management time, it actually means that it's actually cheaper because we're not paying our top managers to expend that much time. And of course, management time is expensive, so the less time that we can spend on this budgeting, the more time we can get involved in actually running the business in other ways. So an incremental budget is easy. Of course, one of the problems with incremental budgets is that any performance issues that were in the original budget, any waste, any slack, any inefficiencies, are just going to be encouraged and possibly even inflated in a subsequent budget, in an incremental budget. So any kind of slack that was in the budget is likely to remain. It also doesn't do much to actually improve performance. Basically, just takes last year's performance and basically just repeat, do again. Maybe the performance last year was actually pretty bad, and if we're going to just do a budget based on last year's budgeted or actual results, then it doesn't really go a long way to actually improving the process or improving performance. So one of the key things, or two of the key things that an incremental budget is not great for, is that it builds in slack and it fails to make any significant improvements. So moving on to zero-based budgeting now. Zero-based budgeting is what? It's where we wipe the slate clean, we open up a brand new Excel spreadsheet. It hasn't got anything on it, maybe just a bit of a template, if even that. A true zero-based budget probably doesn't even have a template. It's a complete blank worksheet, it's a blank sheet of paper, and we start from scratch and we question everything. Do we actually need to use electricity? Are you sure? Okay, fine. We need to have some lights. We need to have, some plugs. Do we actually really need those fan heaters? So it really kind of it questions every single expenditure, every single cost. So it builds everything from the ground up. Therefore, it's responsive to the environment because it actually looks at everything that's happening within the business and actually says, do we need it? How much do we need it? Are there any alternatives? So it should actually be very relevant to what's actually going on within the business. So it is actually looking at the business environment and responding and building up the budget in relation to that. So it's good in terms of responding to the environment. It's close to the business, of course, because it actually looks at and analyses the business. It increases efficiency. Why? Because anything that is not efficient, anything that's not absolutely necessary, it looks at it and says, well, yes, we had it last year. How much value did it create? Was it really, that good? Was it really necessary? And therefore, it cuts out a lot of slack. So therefore, one of the good things about it is it responds to the environment. It's close to the business. It increases efficiency. And also, because it asks questions, it actually involves a lot of people. It encourages the participation of, other members of the business, people that are responsible not just for creating the budget, but for also creating a cost and to to a certain degree, everybody within a business creates some kind of cost for the business, whether it be for salaries or for spending on stationery or for actually doing the operations of the business. And so therefore, it really does get everybody involved. It gets everybody kind of cost conscious and also value conscious as well. Is this kind of, bringing good value to the business? Do we actually really need it? Are there any alternatives? Of course, doing that does take time. It takes a lot more time than just repeating the budget from last year or repeating the actual results and putting them into a budget, which is what incremental budget essentially does. So there is a time element of zero-based budgeting. It can be quite time consuming, and because of that, and you're tying up management time in doing these zero-based budgets, of course there is a cost involved. So that's an analysis of zero-based budgeting. Then, of course, we've got rolling budgets. Now, rolling budgets can take a variety of forms. In a sense, you can almost have a zero-based rolling budget where you just add on an extra month or an extra period, maybe a quarter, and with that you then build up your budget in that way. But one of the key things about a rolling budget is that you never really have a budgetary period that is set for a year, for example. As one period finishes, you budget for the next period, and it continues rolling in that way. So one of the good things about it is that you're constantly up to date. You're constantly creating a new budget for a new period. So the planning period is always available, and you're almost firming up each new period as it comes along. That helps to reduce uncertainty, and even in my own organisation, we do take this rolling budget approach. Yes, we do have a kind of like a financial accounting period. We do have a year end, but in terms of updating our numbers and forecasting, we update those every single quarter. So we have a rolling quarterly budget, which we call our forecast, and every quarter we restate the numbers, not just for that particular quarter, but for the entire year as well. So we're always every quarter looking at what our year-end numbers would be, what our year-to-date numbers would be. Of course, there's a time and a cost involved in that. So the reason why we don't do monthly rolling budgets is because there's other things that we've got to do with our resources. With the accounts team that we have, we've got to do our month end, for example. We've got to do our financial reporting, our balance sheet, our income statement. We've got to do our cash flows. We don't have time, in addition to doing all those things, to be updating these budgets every single month, because it would almost be a full-time job, and it may not actually be that beneficial to keep on updating our budgets with such frequency as would be required for a monthly budget. So we do it quarterly, and that's how we balance the time and cost trade-off. So with all of these methods, if it does take any more thought and does take any longer than an incremental budget, then of course it's going to take more time, and more time is cost. But the advantages of a rolling budget is that it does help to reduce uncertainty, and it does keep things up to date. Then we look at our flexible budget, and flexible budget means that we can change it. We can flex it as either sales goes up or down. As costs change, we can tweak the budget and adjust the budget based on how much sales or usage or activity levels that we are performing. One of the good things about flexible budget is that it does highlight unused capacity, in terms of it does make us aware of what's not being used, where there's slack. Also, most costs in businesses are actually fixed. So flexible budget is great when there's a lot of variable costs. If sales go up 10%, you'd imagine variable costs will go up by a similar percentage. But if most of businesses in the Western world, for example, are service-orientated businesses, where you naturally, with those organisations, have high level of fixed costs, i.e. salaried staff and buildings, etc. Then having a flexible budget, which is really kind of more geared to manufacturing or organisations that have a high degree of kind of marginal costs, unit costs, and variable costs. Then if you have a lot of fixed costs and many overheads, then having this kind of flexible budget is of limited benefit, because it's not really going to change much of your overheads or your fixed costs as you flex the budget, with regards to kind of sales volume and activity levels. So flexible budgets are of limited value, pretty much in the modern world of business. Finally, we're looking at activity-based budgets. Activity-based budgeting is probably one of the more complex areas of budgeting. It's more difficult to explain. An activity-based budget is a budget where you have a certain activity levels. You have more than one activity level. For example, you have different kind of cost drivers, as it were, cost pools. And basically, you look at the different drivers of costs, and you allocate your overheads. You break them down by various activities. So one of the negatives you could say about activity-based budgeting is that it's not easily understood by most managers. I'm an accountant, and even for me it's a bit of a mouthful to actually describe. One of the things is that it can be quite complex to prepare and to present. One of the great things though about activity-based budget is that it does link quite good to a business's objectives, simply because the activities that you choose, the cost drivers, the cost pools, are very intimate and intricate with the organisation. So it kind of really ties well with and hits home with a lot of the things that would be important to an organisation. Number of deliveries when it comes to delivery costs, and things that are really core to an organisation. That is what activities can be based on, and so therefore it does have a strong correlation, activity-based budgeting, with the objectives of an organisation. And for that very reason, an activity-based budget can be really useful in helping you to identify your critical success factors. What must we absolutely get right in this organisation to be successful? Well, if one of your activities is getting deliveries on time, and one of the key drivers of your costs are delivery costs, and you are creating a budget, and one of your cost drivers and cost pools are related to delivery costs, then you can quite easily identify that delivering on time, making sure that your delivery costs are within a certain range, that can hit the nail on the head for identifying a critical success factor. So an activity-based budget can actually not only link strongly to your objectives, but it can actually help you with strategic management accounting in terms of identifying your critical success factors. It also ties in well when you're doing your SWOT analysis. You can decide what your strengths, weaknesses are, and your activity-based budget can be correlated to that, so that you can actually focus on those areas that you absolutely need to nail. So that's activity-based budgeting. So far we have discussed the performance cycle. We've discussed Prime, of course, being what you need to do with these budgets, whether it be incremental, zero-based, it can be rolling, it could be flexible, it could be activity-based budgeting. But with Prime, you need to make sure that you've got your planning in place, that you've allocated who's responsible, that you've integrated it within the business, that the business, i.e. the staff, are motivated, and that you're able to evaluate those budgets. But then we also need to have a look at something to do with budgeting that is not a categorization of budget systems, but is something that influences budgeting. One of the key things that we need to look at within this area of performance management and control is learning curves. When we have a new product, we may not know how to make it very efficiently. There may be design features that need to change and be updated. For example, Amazon have in recent years, launched a product called Kindle, which is an ebook reader. When the very first Kindle came out, the screen wasn't very good, and people's eyes got tired. And one of the things that people didn't like about reading on a computer screen was, of course, their eyes got tired because of the way that the computer screen throws light into your face and makes your eyes tired. Well, the ebook reader was supposed to help that, but the screen wasn't very clear. So they, with this new product, they brought out an updated version that had a better screen resolution. But of course, when people read, they often like to read at night. Obviously, when you're used to reading a book, you've got your light switched on, you've got a lamp, or you've got a night light, and you read in bed, in semi-darkness. One of the things that people found quite useful was they found it quite useful to have a light specifically for their Kindle. They used to buy these extra little accessories that clip on a light, and you could read your Kindle in the dark with this clip-on accessory. But it was a little bit kind of clunky, and wasn't ideal. So then, of course, Amazon launched this Kindle Paperwhite, which had these little LEDs built in that kind of shone light across the page, and now you can read a book in complete darkness on your Kindle. So the thing that I'm getting at here is that when it comes to budgeting and it comes to cost, what did Amazon do when they decided to launch their Kindle? And they said, well, this is the product life cycle, this is what we're going to do, we're going to invest a lot of money in research and development, we're going to launch this product, we're going to do all this marketing, and then we're going to sell millions of Kindles. Well, as they were selling these Kindles, they had to go back to the drawing board, they had to go back and redesign. When the Kindle first came out, it had buttons, and you had to push physical buttons. Now you've got touchscreen Kindles where you actually just have to touch the screen and it turns the page. So every single year, Amazon have come out with a new and updated and a redesigned and improved version of the Kindle. What does that do to their budgeting? How does that affect the performance of the business in that way when you have a new product? And of course, when you have a new product, you may actually have to budget in the learning curve. And it's a learning curve that I'm talking about here. It's the learning curve that may say, well, actually, you may actually need to have an allowance or a provision, because you may not know how to make them very well. You may not know how to design them very well. You may have to go back to the drawing board. Your customers may come up with suggestions and things that will actually improve the product. So be aware that when you're budgeting for a new product, there may be reasons why you need to actually have a certain amount of the budget there for this learning curve. Not just for new products, but also for labour efficiency as well. When I first started at the construction company that I'm at as a senior accountant, I didn't know how that particular organisation did their month end. Therefore, I wasn't very efficient. Therefore, when I was going through month end, I needed to call upon the help and assistance of colleagues who had also gone through the month-end process, and also my line manager as well, and they needed to invest some time in me to get me up to speed with the month-end process. And it wasn't just the first month, it was the first few months. So therefore the efficiency of me doing the job was actually down. How does that affect an organisation's budget, for example? If you are hiring a new staff or opening a new division and you've got new people, you can't expect them to be operating at the same level of efficiency as people who are more established. So therefore you need to take into account the efficiency of your staff, and therefore the learning curve that they go through as they become more efficient, more proficient, more experienced. That would have an effect on your budget, especially when it comes to labour hours and also production volumes and how quickly and efficiently you can produce things. Variable overheads. How are variable overheads linked to the learning curve? Well, as an organisation gets better and more efficient, we'd like to think that the costs of the variable overheads will go down, and also, the amount of overhead that's used. And also, we've touched upon the experience curve as well. As staff get more experienced, they actually become better, quicker, faster, and more productive at what they do. All of these things are part of the learning curve. Behavioural issues. Now, we will look at behavioural issues in performance management in more detail a bit later on, when we look at performance measurement in terms of strategy, rewards and behaviour, and we look at human resource planning, appraisals, the purpose of appraisals, the approaches to appraisals, and the benefits. So we will look at rewards and behaviour. We'll look at measurement changes for performance, agency theory. We'll look at fair standards, dysfunctional behaviour. We'll look at management styles such as Hopwood, where we've got a style of having a constrained budget, or a profit-conscious style, or a non-accounting style. So we will look at all these kind of behavioural and HR aspects a little bit later on in the course. But for now, the key thing that we want to look at is motivation and participation. Goes back to our performance cycle, where the M is for motivation. We want to have a budget that may possibly be a target for our staff. So not only do we give them the numbers to say, well, let's stick to these numbers, but also we give it to them to motivate them. And for something to be motivating, it has to be challenging. But it also has to be seen as achievable. If you give somebody something that's just easily achievable, they say, oh, well, that's easy, just whatever. It's not very motivating. If you give somebody something that is too challenging, they'll just be overwhelmed, and they say, well, you know what, what's the point? I'll just give up now. So it needs to strike the right balance between being challenging but also being achievable. Another aspect of behavioural issues is participation, and how you expect staff to participate in the budgetary process, in performance management and control. Is it a top-down approach where the participation is, this is the information that comes up from on high and it gets pushed down the organisation and people are told this is what you need to do? Or is there a bottom-up approach where you solicit feedback, or you elicit feedback from your staff and you listen to what they have to say about the budgetary process, about performance management, about the control, and you take on board the feedback and what they say, and there's a bit of a two-way process. So participation, bottom up, top down, linking into behavioural issues, linking into the value of actually having a budget, and of course the alternative approaches to budgeting. So this is some of the things, or these are some of the things that you need to think about when it comes to performance management and control, when it comes to alternative approaches to budgeting for control. And the behavioural issues you need to think about are the motivation, whether it's suitably challenging and achievable, and also participation, whether it's a top-down or bottom-up approach. And finally, one of the key things that we need to look at, and possibly one of the most important things we need to look at when it comes to performance management and control, alternative approaches to budgeting for control, is the movement that is beyond budgeting. Now, beyond budgeting is all about moving away from actually setting a formal budget and instead doing something that can actually help the organisation and move the organisation forward without actually being constrained by a budget. And it's worth looking at this in a little bit more detail if you can. So do feel free to read up on Beyond Budgeting. There is an article on the ACCA website for ACCA P5 that is called Beyond Budgeting, and it's well worth a read and being familiar with that. Target setting. Budgets can be used for target setting. They could be setting aspirational targets. And therefore, should it or should it not be used for performance appraisal? So, essentially, what is the budget? Is it something that we actually are expected to follow and to conform to? And therefore, this is the budget, please stick to it? Or is it more aspirational, where actually they don't really expect you to hit the budget? They would like you to hit the budget. They've put the budget a little bit out of your reach and, to stretch you a little bit. And therefore, the whole budgetary process becomes more of a kind of performance appraisal exercise. Advocates of beyond budgeting say that you shouldn't be using budgets for that purpose, and that if you want to set targets, but don't set a budget that is going to be extremely challenging, and use it to evaluate the performance of your managers and staff. Also, strategy process. You could set strategy from up on high, and then hand out these budgets. But what about if people lower down the organisation? Maybe the leaders of separate divisions, or managers that are responsible for certain areas. What if they were involved in strategy? So Beyond Budgeting thinks about having a devolved strategy process. And also, how do we measure performance then if we're not looking at the budget? How do we know whether people are doing well or people are doing bad? How do we know if the organisation is doing well and if the organisation needs to improve if we're not comparing against the budget? Well, of course, what we can do is we can make our performance appraisal relevant to other organisations, relevant to other departments or even other functional areas. And that goes back to what we discussed in our introduction to strategic management accounting, which is benchmarking. Benchmarking is one of the alternative ways that we can exercise performance management and control without having to rely on budgets. Performance management and control can also look at trend analysis, looking at what's happening in the external environment. We can also look historically at what's happening within our organisation and look at the trends and the movements that we're going towards. Looking at things that may happen within the future, and looking at different options and different scenarios. So by benchmarking and by analysing trends, that is a way that we can analyse performance, and it's also a way that we can help to control the organisation. And of course we'll look at different measures for controlling the organisation, different measures of performance management as we go further through the ACCA P5 syllabus. So that concludes our performance management and control area. What we've done here is we've evaluated the strengths and weaknesses of alternative budgeting models. So we've looked at activity-based budgeting and its link to objectives and critical success factors. We've looked at flexible budgets, how a flexible budget can highlight unused capacity, but is limited in modern day business because most costs are fixed. We've looked at our rolling budgets, where our rolling budgets can reduce uncertainty and also keeps us up to date, but there is a extra time and cost in actually doing that, especially if the rolling budgets are quite frequent, i.e. monthly rather than quarterly. We've looked at zero-based budgets and how zero-based budgets respond to the environment, keep close to the business, increase efficiency and, encourage participation. Again, that probably involves even more time and more cost. It can be very time-consuming to do a zero-based budget. How often do you update a zero-based budget? Well, it can be quite a painful experience. You may only want to do it yearly, so therefore, does it keep up to date like a rolling budget would? And of course there's the incremental budget, which is probably the simplest, quickest, most straightforward way of implementing a budget, but the fact that it's easy, it's also a kind of slack, and could slightly say it lacks the discipline of the other approaches, and it doesn't do very much to enhance the performance of the business. And the fact that this is the ACCA P5 Advanced Performance Management paper, it's probably not the best method to recommend. Unless, of course, you're a very fast-moving business that takes a freewheeling opportunism point of view. We've also assessed how budgeting may differ in not-for-profit organisations from profit-seeking organisations. We didn't really touch on this, in any great detail at all, but from a common sense point of view, we want to make sure that in a profit-seeking organisation, the idea there is to maximise profit. And we'll look at this in more detail later on in the course, because we actually look at performance measures for not-for-profit organisations, and then the budgeting element, of course, will come into there. If you are within a not-for-profit organisation, or you need to discuss that within the exam, and you need to discuss the context of budgeting, you need to think about the value for money, the 3 E's, which are economy, efficiency and effectiveness, and the stakeholders that are involved within the budgeting process. And finally, we've also evaluated the issues raised by advocates of beyond budgeting. So by evaluating, we're looking at the strengths and the weaknesses. So one of the good things about beyond budgeting is that it relates performance appraisal to things that may be bit more strategic and meaningful to the organisation, i.e. trend analysis and benchmarking, rather than budgeting, which could be quite internally focused on the organisation's historic numbers or its internal processes. So beyond budgeting can look beyond the actual realms of the internal aspects of the organisation. It can be quite good for target setting and for motivation, and it can help devolve the strategy process. But one of the things about beyond budgeting that may not be looked on too favourably is it still seems to be quite radical. Businesses feel quite secure and robust in having a budget. Finance managers and senior managers do like to look at and compare what an organisation have done against budget. So it's a completely kind of alien concept when it comes to most organisations. So it's still not clearly understood by quite a lot of managers and finance professionals. So it still needs to be understood in that aspect, and that's one of the weaknesses, is that it's not an easy concept to understand, especially for those professionals who are slightly long in the tooth. So that's our revision, and that's my conclusion of the performance management and control aspect. Do read up on Beyond Budgeting so you can get a bit of a deeper understanding and approach. And if there's one budgetary system that I would say to look at, I would absolutely go for activity-based budgeting. Know how to do that, know what the intricacies of that are, how to build one, how to do one. It links into activity-based management as well, and activity-based costing, all key areas of performance management, whether it's F5 ACCA performance management or P5 advanced performance management. Know your activity-based costing, know your activity-based budgeting, know your activity-based management. If there's another area to look at, it would be good to look at zero-based budgeting, and then finally rolling budgeting. Zero-based budgeting, how to wipe the slate clean and build up a budget from scratch, and then rolling budgeting, basically what are the key things there, again evaluating the strengths and weaknesses of that. One key thing as well when it comes to budgeting is about batches and being able to produce batches. For example, if a company has just produced the first batch of 10 units of a new product, and it takes a certain amount of time to produce that batch, and they've got a learning rate of a certain percentage, are you able to calculate the numbers of hours that should be budgeted for labour and variable overheads to produce the next 15 batches, for example? Assume after the 16th batch no further learning effect is expected, so the time taken for the 16th batch will be the time taken for all subsequent batches, i.e. a steady state is reached. Are you able to calculate the time taken for the subsequent, i.e. 17th batch? So this goes back to our learning curve, and this is just a technical accounting area that you should be familiar with. So, if you've got time, just do a couple of practice questions when it comes to producing batches, and revise the learning curve as well. There is a formula Y equals AXB. So again, it may be worth actually learning that formula, where the Y is the cumulative average time per unit taken to produce the X number of units. So Y is what you're trying to work out. It's the cumulative average time per unit to produce X number of units. The A is the time taken to produce the first unit. You multiply that by X, which is the cumulative number of units, and then that is then to the power of B, which is the index of learning, i.e. the learning, we'll stick to calling it the index of learning, because it can be quite complicated to simply just explain. But you calculate B by doing log R over log 2, where R is the learning rate. So again, using your scientific calculator, you would need to know log R over log 2, which gives you your B. Of course, you've got A times X to the power of B, where again A is what? A is your time taken to produce the first unit. X is what? X is the cumulative number of units. B, which is what you're squaring it by, is log R, which is the learning rate, divided by log 2. Not a difficult formula to learn, y equals AXB, but you do need to know what the variance elements are. You do need to know what you're trying to calculate. You do need to know what the y is used for, what the cumulative average time per unit taken to produce X unit is for. So that's just a nice, accountant exercise to perform. But do remember that this is a strategic paper, and it's much more important, especially in this particular chapter, for you to understand what beyond budgeting is, what ABB is, what ZBB is, rather than having fun on your calculator. So I hope this has been useful, and do check out the other revision aids. And if you do have any feedback, feel free to contact me.